We are forecasting now dollar to resume its bearish trend, and therefore we are constructive on EM fixed income as a broader asset class.
So you're saying this is just more just a correction of the overbought levels that we've seen last year, that we're not seeing anything more sinister in the picture when it comes to
Absolutely, and we did get some downside surprise in euro data. Essentially, the whole thing began from the fact that the dollar began to appreciate against the euro. And in the meantime, there was these concerns on what happens in protectionism risks in EM, so several other issues, and some idiosyncratic issues like Argentina and Turkey. So I think it did kind of cause a correction, but we think the fundamental trend of dollar depreciation is going to resume soon.
Yeah, I mean, Morgan Stanley, you guys termed the Fragile Five back in the day. You yourself also tweaked it back in 2016. You included South Africa, Turkey, Indonesia, Mexico, and Colombia. Now, when you assess the risks out there in the developing world, is it time to kind of rejig that description of what you think is perhaps most vulnerable in this part of the world?
Well, we think that the EM story on a broader basis is fine. Essentially, we approach it in two manners. One is we look at the policy mix. What are they doing to monetary policy, fiscal policy, and labor market policies? And then the outcome of that in form of macro stability indicators in inflation and current account deficit. So when you take most of the large EMs on these two parameters, they seem to be fine. So therefore, we are constructive on EM growth outlook too. We expect actually the differential between US and EM's growth outlook to continue, which is actually beginning already last 4 quarters. And the fact that EM's growth is driven by capex and productivity improvement, it looks like it's sustainable.
But Chetan, just following up on Yvonne's point, though, what do you think emerging markets? And I know not all emerging markets are the same, but what are they most vulnerable to right now? What shock are they most vulnerable to?
I think the most important parameter that we were watching there is US rates and dollar. So if you do see US cost of capital rising, that transmits to emerging market through currency. And so therefore, we have to watch both these trends together. And as I mentioned at the start of this discussion, we are expecting actually the dollar to begin to resume its depreciation trend. And in the background, we are not expecting 10-year bond yield to overshoot in a meaningful manner. And so therefore, we think that the backdrop does allow EMs to continue with their fundamental story, which is an improvement in growth driven by capex and productivity.